think many investors are looking at AI through the wrong lens. If you have been paying attention to the headlines over the last couple of years, it's easy to believe that AI itself is the investment story. I actually think that's incomplete. AI is the headline, infrastructure is the story. Whenever a major technological shift happens, most people focus on the product they can see. Very few people pay attention to the infrastructure required to support it. If I handed you $1 million today and told you that you could not touch it for the next 10 years, where would you put it? Would you put it in the stock market? Would you buy real estate? Would you invest in private businesses? Would you chase the AI boom that seems to dominate every headline? Or would you hold on to cash and wait for more certainty? The answer to that question tells us a lot about how we think about risk, opportunity, and wealth building. And right now, investors everywhere are struggling with those exact same questions and decisions. Welcome back to the Wealth Vibe Show. I'm your host, Vinki Loomba. For those joining me for the first time, my background spans technology, academia, business, and real estate investing. Over the years, I have had the opportunity to evaluate investment opportunities, work alongside investors and operators, and study how wealth is built across different market cycles. While I'm not a financial advisor or wealth advisor, I spend a great deal of time analyzing markets, evaluating opportunities, and having conversation with investors, operators, entrepreneurs, and industry leaders. Today's conversation is simply my perspective on the market, the trends I am observing, and the questions investors seem to be asking most often right now. Over the last several months, I have had countless conversations with investors, entrepreneurs, and business owners who are all trying to answer the same question. What is the smartest way to position ourselves in today's environment? So today, we are going to talk about why investors feel uncertain, how wealth is actually built, how to think about due diligence, and where capital appears to be flowing as trends like AI continue to reshape the economy. If you have been feeling uncertain, confused, overwhelmed by everything happening around us, this episode is for you. So let's dive in. One of the biggest misconceptions investors have is believing that uncertainty is something unique to the current market. Every cycle feels different when you're living through it. Today, we have concerns about interest rates, inflations, artificial intelligence, government debt, commercial real estate, geopolitical tension, and economic growth. A few years ago, it was COVID. Before that, it was financial crisis. Before that, it was dot-com bubble. We lived through that, right? The specific headlines change, but uncertainty never goes away. That's important because many investors are waiting for a future version of the market where everything becomes clear. They're waiting for the moment when they finally feel confident enough to move forward. But the problem is there's going to be one more reason to wait, one more thing to figure out, one more concern to resolve. If we are waiting for the perfect moment when everything feels certain, that moment, I would say, really comes or never comes. In fact, some of the greatest wealth building opportunities in history appeared during periods when uncertainty was at its highest. Think about investors who bought quality real estate after the financial crisis. Think about investors who continued buying strong companies during the early days of COVID. And think about entrepreneurs who started businesses when everyone else was focused on fear. None of them had certainty. What they had was conviction. And there is a big difference between the two. Certainty means knowing what will happen, and conviction means being comfortable acting when you do not know exactly what will happen. The investors who build wealth consistently understand this distinction. Today, there are four major forces shaping the investment landscape. The first is interest rate. For more than a decade, we operated in an environment where money was incredibly cheap. Investors became accustomed to low borrowing cost, easy financing, and rising asset values. Today, we are operating in a different environment. Capital is more expensive, underwriting matters more, and investors are being forced to focus on fundamentals again. So, the second force is artificial intelligence. Whether you believe AI will change everything or whether you think the excitement has gotten ahead of reality, one thing is clear. Capital is flowing aggressively into the sector. Whenever capital flows in that magnitude, opportunities are created. The third force is demographics. This topic rarely receives headlines, but demographics drives housing demand, migration patterns, labor markets, consumer spending, and long term economic growth. Many of the strongest investment opportunities over the next decade will be influenced by demographic shift that are already underway today. The fourth force is capital allocation, and I think this is a very important one. One of the things I pay close attention to is not what people are saying, but where money is actually moving. Capital leaves clues. When institutional investors begin deploying billions of dollars into certain sectors, I want to understand why. That does not mean following the trend or following the crowd blindly. It means understanding what trends are driving those decisions. Now let's address one of the most common question I hear, like this investor, he was asking me the other day, he said, Vinki, what if I invest today and the market drops tomorrow? Fair question, right? Nobody enjoys watching the value of investment decline immediately after investing. But what often sits beneath that question is something even deeper. Most people are not afraid of losing money. They are afraid of making a decision that feels wrong. They are afraid of regret. They are afraid of looking back and thinking that they should have waited. But successful investors understand that temporary volatility is very different from permanent loss of capital. Every investment experiences periods of uncertainty. Every investment experiences moments where market questions its value. The key is understanding what you own and why you own it. Another question I hear very frequently is this: should I wait until after the next recession? And my answer is always the same. Nobody knows exactly when the next recession will come. Nobody knows exactly how to handle that or how big or severe it will be. Nobody knows how markets will react to it. What I do know is that many investors spend years waiting for an event that we cannot predict right now and let the opportunities pass by. The goal isn't to perfectly time the market. The goal is to consistently allocate capital into quality opportunities while managing risk appropriately. And that leads me to what I believe is the single biggest mistake investors are making right now. They are waiting for certainty, number one. They are waiting for interest rates to settle, number two. And they are waiting for inflation to disappear. They are waiting for political uncertainty to fade. They are waiting for the economy to become clearer. They are waiting for perfect deal. They are waiting for perfect moment. The problem is that that certainty isn't coming. There will always be another headline, another concern, another prediction, another reason to wait. In my experience, many successful investors discover that clarity often comes after commitment, not before. A lot of people think that they wanted to have the clarity before the commitment, It's the opposite. They gather information, they perform due diligence, they understand the risk, and they make thoughtful decisions and move forward. Not recklessly or emotionally, but like I would say more decisively, because they understand something many people forget. The cost of waiting can be just as expensive as the cost of being wrong. And before we talk about where smart money is moving today, I think we need to talk about something even more important, how wealth is actually built. Because if we are going to understand where smart money is moving, we first need to understand how smart money thinks. Right? The money has to think before it moves. So one of the biggest observation I made over the years is that most people think wealth is built through investments. They spend enormous amount of time looking for right stocks, right real estate deals, the right startup, the right fund, or the right market. They believe that somewhere out there is the investment that will finally change everything for them. But when I look at the investors who have actually built substantial wealth, that's what they are not looking for. Or that's not the trend that I see. What I see is something much less exciting and much more powerful. I see people who learned how to allocate capital. They understand the wealth isn't built by finding one great investment. The wealth is built by repeatedly making intelligent decisions with capital over a long period of times. I remember a period of time in my own investing journey when I was consistently looking for the next opportunity. I thought the answer was finding that just the best deal out there in the market, or the best market, or just the best strategy. And what I eventually realized was that the answer wasn't finding more opportunities. It was becoming clearer about what role each investment was supposed to play. Some investments were helping me grow capital. Others were helping me generate income. Others were helping me create relationships and access opportunities I would not have had otherwise. Once I started thinking that way, investing became much less about chasing opportunities and much more about building a system. The reason this matters is because different investments serve different purposes. Some investments are designed to grow wealth, some are designed to create income, some are designed to preserve wealth, some are designed to provide liquidity and flexibility. The mistake many investors make is expecting one investment to do all four jobs. That's like expecting one employee to be a salesperson, accountant, operation manager, attorney, and CEO all at the same time. It does not work very well. The most successful investors I met think very differently. They do not ask, what's the best investment? They ask, what role does this investment play in my overall strategy? One of the most common questions I hear is, should I focus on building cash flow or building net worth? I love this question because it reveals how many people think these two goals are competing with each other. But trust me, they're not. They're simply different phases of journey. When people are younger and still building their financial foundation, growth tends to matter more. They're trying to accumulate assets, they're trying to increase their earning power, they're trying to build a larger base of capital. At that stage, maximizing growth may make perfect sense. But as wealth grows, priorities often begin to change. People start valuing freedom differently. They start valuing predictability differently. They start asking different questions. Instead of asking, how much can I grow my portfolio? They start asking, how much income can my portfolio generate? The objective changes. And when the objective changes, the strategy changes. I have met people with very high net worth who still do not feel financially free because everything they own requires constant attention. Do this, do that. And they are still entangled. But at the same time, I have met investors with significantly lower net worth who have built strong cash flowing portfolios and enjoy tremendous flexibility with their lives. Neither approach is right or wrong. The key is understanding where you are and what you're trying to accomplish. The goal isn't choosing cash flow or net worth. The goal is knowing which one deserves greater attention during your current stage of life. Another question I've been hearing a lot lately, should I pay off debt or should I invest? This question comes up every now and the answer is usually more nuanced than people want to be. The first thing I always ask is what kind of debt we're talking about. High interest rate consumer debt is very different conversation than long-term fixed rate investment debt. If someone is carrying credit card debt at 20% interest or 25% interest, paying that off is often one of the best risk adjusted returns available. It's difficult to consistently earn 20% while taking less risk. But let's say if we're talking about fixed rate mortgage at 4 or 5%, now the conversation changes because now we are comparing the cost of that debt against the possibilities or the opportunities available for that capital elsewhere. The real question isn't whether debt is good or bad. The real question is whether your capital has a higher or more reliable use somewhere else. One of the things sophisticated investors understand is that capital is always competing for opportunities. Now let's talk about another question that is showing up everywhere right now. Should I stay liquid or should I put my money to work? This is one of the defining questions of today's market. For years, cash earned very little. Today, investors can earn a reasonable yield on money market funds, treasury bills, and other short term instruments while maintaining liquidity. As a result, many investors are asking themselves an important question. Should I keep waiting on sidelines or should I start putting more of my capital to work? So that has caused many people to pause. And honestly, I understand why. Cash feels safe to a lot of people because I learned that from the very get-go in my life. In my life, I was taught, go study, work hard, make tons of money, and then put the cash under the mattress, basically. Because cash feels flexible, cash feels comfortable. But cash also carries a risk that many people underestimate. And it's the opportunity cost, that intrinsic value. The risk of not participating, the risk of watching opportunities pass while your capital remains on the sidelines. Now, I'm not suggesting investors should deploy every dollar they have. Liquidity matters, emergency reserves matter, dry powder matters. Having capital available when opportunities emerge can be incredibly valuable. But sophisticated investors really think in terms of all or nothing. They're asking what percentage of the capital should remain flexible and what percentage should be working towards long term objectives. That's a more useful conversation because wealth is usually built through productive assets, ownership, businesses, real estate, innovation, things that create value over time. And that brings us to one of the most important skills an investor can develop, due diligence. You know what's interesting? Most people think due diligence is about reviewing spreadsheets, financial statements, offering memorandums, market reports. And yes, don't get me wrong, those things really matter. But after years of evaluating opportunities, I have come to believe that great due diligence is really about asking the right questions. Some investors might think, what is she talking about? I always ask the right questions. But most investors spend their time trying to prove why an investment will work. Sophisticated investors spend their time trying to understand why it might not work. One of the most common questions I hear from passive investors is, how do I know if I'm looking at a good investment or a good presentation? This is an incredibly important question in today's world because great investments do not always have great marketing. And great marketing doesn't always represent great investments. We are living in an era where everyone has access to podcasts, webinars, social media, professional presentations, and sophisticated branding. It's easier than ever to create the appearance of expertise. But that does not mean that expertise isn't real, but it does mean investors have to look deeper. When I evaluate opportunities, I am far less interested in how impressive the presentation looks and far more interested in the assumptions behind it. How realistic are the projections? What happens if things take longer than expected? What happens if conditions change? What happens if the business plan encounters challenges? Because eventually reality shows up, and when it does, the quality of the opportunity becomes much more important than the quality of the presentation. That leads to another question I think every investor should ask. And honestly, I think this question can save people enormous amount of money. What would have to happen for this investment to fail? Most investors never ask that question. They are focused on the upside, they're focused on the returns, they are focused on the opportunity, but sophisticated investors often start somewhere else. They are trying to identify vulnerabilities. They are trying to understand what assumptions matter most. They are trying to determine what could go wrong. They are stress testing the opportunity before they become emotionally attached to it. And here's what's interesting, this mindset does not make them more pessimistic. It actually gives them more confidence because once they have identified the risk and still like the opportunity, they can move forward with conviction. They are not investing based on hope. They are not investing based on understanding. And I think that's one of the most important shifts any investor can make because wealth is not built by chasing opportunities. Historically, many investors have built wealth by allocating capital thoughtfully, managing risk, and allowing compounding to work over a long period of times. Once you begin thinking that way, something changes. You stop asking, what's the next hot investment? You start asking, what trends are likely to create value over the next decade? That's the right question, right? And that brings us to where some of the largest pools of capital in the world are moving today, artificial intelligence or AI. But here's what's interesting. I think many investors are looking at AI through the wrong lens. If you have been paying attention to the headlines over the last couple of years, it's easy to believe that AI itself is the investment story. I actually think that's incomplete. AI is the headline, infrastructure is the story. Whenever a major technological shift happens, most people focus on the product they can see. Very few people pay attention to the infrastructure required to support it. Think about the internet. Most people remember the websites, the companies, the application, but behind all that, there was an enormous build out of infrastructure, fiber networks, server farms, telecommunications, physical systems that made the digital economy possible. And I think we are witnessing something similar today. Every AI model needs enormous amount of data to learn from. That data has to be stored, processed, moved, and accessed quickly. Then once people begin using AI tools at scale, every prompt, every search, every image, every workflow, and every application requires computing power behind the scenes. That computing power does not exist in the air. It lives inside physical infrastructure. It lives inside data centers. And those data centers require chips, servers, cooling systems, fiber connections, land, water in some cases, and most importantly, electricity. So when we talk about AI, we are not just talking about software. We are talking about an entire physical ecosystem that has to support that digital intelligence people are using every day. And that is one of the reasons many institutional investors and infrastructure managers are paying very close attention to this space. One question I have been hearing quite a lot lately. Vinki, am I too late for AI? I understand why people are asking it. When a technology dominates headlines, people naturally begin worrying that they missed the opportunity. But I think that's the wrong question. Instead of asking whether you're too late for AI, ask this: what industries will AI create demand for over the next decade? That's the very different conversation. Because technological revolutions do not just create winners in the technology, they create winners throughout the entire ecosystem. The automobile industry did not just create opportunities for car manufacturers, they created opportunities for roads, gas stations, insurance companies, repair businesses, manufacturing, right? So many things. The internet did not just create opportunities for websites, it created opportunities for fiber networks, cloud infrastructure, logistics, data storage. Many investors believe that AI may create similar opportunities across the broader ecosystem, just as previous technological revolutions did. And that's why I think investors should pay attention not only to AI itself, but to everything required to support it. One of the most interesting areas attracting institutional capital today is data centers. Many investors view data center as a form of digital infrastructure that plays a role similar to how warehouses supported the growth of e-commerce. 20 years ago, investors were trying to understand the opportunity behind warehouses because every AI model has to live somewhere, every piece of data has to be stored somewhere, every calculation has to happen somewhere. And that somewhere is increasingly becoming data centers. You agree, right? I think there's another question that I hear all the time. Why so many institutions investing in data centers? The answer is actually very simple. They are investing in demand. Think about this way. Nobody knows exactly which AI company will dominate 10 years from now. Nobody knows which platform will become the largest. And nobody knows which application will emerge as the next breakthrough. But what many institutions believe is that demand for computing power, data storage, and digital infrastructure may continue to increase as AI adoption expands. So rather than trying to predict a single winner, they are investing in the infrastructure that supports the entire ecosystem. Is similar to investing in railroads during industrialization or warehousing during the rise of e-commerce or cellular towers during the growth of mobile technology. They are investing in the foundation. And speaking of foundations, I think there's another part of this story that most investors are missing entirely: power. Most conversations about AI focus on software. Some focus on semiconductors, very few focus on electricity. But without power, none of this works. No data centers, no cloud infrastructure, no AI models, no computing, nothing. And that's why many experts believe one of the biggest challenges over the next decade won't be simply just developing something in AI or developing a better AI model. It will be generating enough power to support the infrastructure behind AI. How cool is that? The next major investment story may not simply be an AI story. It may be an energy story or a power story or an infrastructure story, because every technological revolution eventually runs into physical constraints. And right now, one of the biggest constraints is energy. That leads to another question I hear very often: should I invest in AI stocks? And my answer is probably different than what many people expect. Maybe, maybe not. Because the opportunity isn't always where the excitement is. Sometimes the opportunity is supporting the excitement. When everyone rushes towards the obvious opportunity, sophisticated investors often begin looking at what is it all about, or what is beneath this, who supplies the infrastructure, who owns the assets, who benefits regardless of which company wins. Those are often the questions worth exploring. That does not mean AI companies won't be successful. Many undoubtedly will, but investors should remember that innovation often creates opportunity far beyond the companies making headlines. And that's where I think many sophisticated investors are focusing their attention. What is smart money actually doing right now? If you spend enough time around experienced investors, family offices, and long term capital allocators, something becomes very clear. They are not chasing every headline. They are not chasing strategies every month. They are not making emotional decisions based on whatever is trending this week or will be trending next week. Instead, they're doing a few simple things, but they're doing it well. They're building cash flowing assets. They're maintaining liquidity and becoming more selective. They're paying more attention to long term trends. And what they're doing is, I think, very important is they are protecting capital. Notice what's missing from that list? They are not trying to predict the future. They are trying to prepare for multiple futures. That's very important distinction. Nobody exactly knows what is next. Nobody knows how economy is going to turn out. Nobody knows exactly where the interest rates will be. Nobody knows which AI company will dominate 10 years from now. But investors can position themselves thoughtfully. They can focus on quality. They can maintain flexibility. They can continue learning and they can continue making disciplined decisions. This reminds me of a conversation I had recently with one of the family office executives. She's a good friend and she shared an analogy that really stuck with me. She said, every market cycle has different players. When money is easy to find and capital is flowing freely, almost everybody can stay in the game. Deals get done, assets appreciate, mistakes are easier to hide, and sometimes it's difficult to tell whether the success came from skill or simply from favorable market conditions. But when the environment becomes more challenging, the game changes. Her analogy was that it's a little bit like sports. At one level, a lot of players can compete. But as the competition becomes tougher, the environment starts rewarding stronger systems, deeper experiences, better preparation, and greater discipline. Her view was that we are entering one of those periods right now, not because smaller operators cannot succeed, but because today's environment is demanding a high level of execution. And honestly, I think there's a lot of truth in that. When interest rates are higher, capital is more selective, and investors are asking tougher questions, execution starts to matter more than stories. Discipline starts to matter more than optimism, and preparation starts to matter more than prediction. As I think about everything we have discussed today, the market uncertainty, wealth building strategies, due diligence, AI, data center, and where institution capital is flowing, I keep coming back to one simple idea that investors who tend to do well over the long period of time aren't usually the ones who make most predictions. They are usually the ones who have a framework. They understand what they are trying to accomplish. They understand why they own what they own, and they understand how each piece fits into their overall strategy. That's what allows them to stay calm when the headlines get noisy. And that's what allows them to avoid chasing every trend. And that's what allows them to continue making thoughtful decisions while everyone else is reacting emotionally. So, if there's one takeaway I would leave you with today, is this: the goal isn't to predict the future. The goal is to be prepared for it. Because none of us exactly know what the next 5 to 10 years will look like. We do not know where the interest rates will be. We do not know what technologies will win. We do not even know what the headline is going to be tomorrow. But what we can do is we can build a framework and we can stay disciplined. We can continue learning and we can make thoughtful decisions with our capital along the way. In my experience, that's what separates investors who are constantly reacting from the investors who are able to navigate different market cycles with confidence. So thank you for spending time with me today. I appreciate you for being part of our Wealth Vibe community. If today's conversation gave you a different perspective on investing, wealth building, or where capital may be moving next, I would encourage you to share this episode with someone who may benefit from it. So until next time, stay inspired, stay intentional, and keep building your wealth vibe.
Thanks for tuning in to the Wealth Vibe Show. If you enjoyed the episode, be sure to subscribe and leave us a 5-star review. And don't forget your free gift. Download the Busy Professional's Guide to Real Estate Investing at loombainvest.com. See you next time with another amazing guest and another powerful conversation.